Hi, good afternoon, ladies and gentlemen. Welcome to the Colliers Capital Markets Investment Services What's Next Virtual Forum Series. Today, looking ahead to prospects and opportunities in China, we have more than 300 attendees from all over the world with us today for this session. So very welcome. Before we begin, some general need to take note of. Today's session will be recorded and scheduled for 60 minutes. All attendees will be muted to enable the speakers to present without interruption. Questions can be submitted via the GoToWebinar question screen at any time. Due to the time limit, we may not have time to answer your questions, but we will respond after the forum. Key takeaway. A recording of this presentation and the slide presentation will be Now, I'm delighted to introduce you to our speakers, who will be sharing their insights and perspectives with us today. Our panelists and moderators are Hang Xu, co-founder and CEO of Forest Logistics, Thomas Liu, partners of Actis, Simon Wang, General Manager of ESR East China, and our Tammy Tang, Managing Director of Colliers China. And of course, Andrew Haskins, our Executive Director of Asia Research. I'm your host today, Betty Wong, and I head the Capital Markets and Investment Services business in China. Together with a team of senior investment professionals across China, to provide our clients with full investment services. With us today include Jimmy Gu from East China, John Lin from South China, Jeff Cui from West China, Winter Yan from North China, and Jason Yan in my China team. And two specialists from our industrial team as well, David Wayne, our logistic expert, and Coco Chen, our data center expert. Thank you, and if I may turn your attention to our agenda for today. We have two sessions for today's forum. Firstly, Colliers Asia researcher Andrew Haskins will give us the presentation on China property market overview. Then we will be moving to a panel discussion, what you want to hear about China logistics, which moderated by Tammy. Okay, let's start our presentation for today. Over to you, Andrew.
Betty, thank you very much. Good afternoon, ladies and gentlemen. Dina, can you go forward one slide, please? Please let me give you an overview of China property markets. Let's start with the outlook for real GDP growth. As you can see in this slide, China will be one of the world's few countries to achieve positive economic growth in 2020. Oxford Economics forecasts 2% for this year. In contrast, nearly all the other major Asia-Pacific economies will see negative growth. Now, for next year, Oxford forecasts 7.8% GDP growth for China. That's a strong upswing. And as the world's second largest economy, China should be able to pull up the whole region next year, just as it did after the global financial crisis. Next slide, please. Now, this chart shows you a range of economic metrics for China, but the important point is that after the very weak first quarter impacted by COVID-19, nearly all economic metrics, real GDP growth, tertiary industry, import value, export value, fixed asset investment, nearly all these metrics have been strengthening steadily. And it's worth looking in particular at import value and export value. They have been surprisingly strong over Q2 and over Q3. We are, of course, now into Q4, and it is worth noting that real-time measures from firms like Oxford Economics point to a continuing strengthening of the economy, and in particular, a strong increase in domestic demand in October, which has resulted largely from the recovery in fixed asset investment so far this year. And this recovery in domestic demand bodes well for consumption and for a continuing recovery in retail sales. Next slide, please. What about the implications for China of the US presidential election? In a word, President-elect Biden's victory is positive. If we look at trade policy, US-China trade tensions will potentially ease from now on, since Biden is likely to take a more moderate approach to trade policy in general. Looking at occupier markets, or the presence, and specifically the presence of multinational companies in Greater China, signs that large MNCs were planning relocation away from China were already minimal. And under Biden, we would expect most MNCs to maintain their presence. And lastly, climate change. Progress on climate change will be a common policy agenda between the US under Biden and China under President Xi, because both leaders have proposed ambitious targets for carbon neutrality. So that's a major potential area of cooperation. Next slide, please. Next slide. Let's look at the Tier 1 office markets in China. Of course, the first quarter was weak, but most cities in China are now seeing rising demand, especially Shanghai. If you look at the right, you can see our aggregate forecast for the 4 Tier 1 cities for demand, supply, rent, vacancy for this year and the next 5 years. For 2020, aggregate net absorption, aggregate demand, will be about 0.75 million square meters. Still a low figure, but not too bad given the very weak Q1. Now that number should recover strongly over the next few years to give a 5-year average of 2.46 million square meters. So demand will pick up. The problem is supply. There is very high supply in Shanghai, Beijing, Shenzhen. For this year, 2020, supply will be far ahead of demand, and even over 5 years, we expect average annual supply to be 1.5 times net absorption. And it's this high supply which explains our rental forecasts. We see a 9.1% drop in aggregate Tier 1 rents this year, but that will ease. And over 5 years, we expect a much smaller decline of 1.8% on average per annum. Now, with high supply, vacancy is going up. We see aggregate vacancy at the end of this year at just over 22%. Guangzhou doesn't really have a problem. Beijing and Shanghai will both peak next year, 2021, but in Shenzhen, we don't see the peak in vacancy till 2023. Next slide, please. Now, one positive consequence, you might say, of pressure on rents is that Chinese cities, on a relative basis compared to the rest of Asia Pacific, offer decent value, and they can therefore continue to attract multinational occupiers. You see there in the center of this slide, Shanghai, Shenzhen, Guangzhou, all good value compared to the rest of the region. Beijing remains the most expensive city in China, but it is still significantly cheaper than Tokyo, Hong Kong, or Singapore. Next slide. Let's have a look at Tier 2 office markets. As in the Tier 1 cities, supply is rising in the Tier 2 office markets. Look at the chart at the top left. You can see supply rising sharply next year in Hangzhou and in Nanjing. More positively, on the top right, after a very weak year in 2020 for nearly all cities except Xi'an, we expect net absorption to recover strongly in 2021 and 2022, especially in Chengdu and in Hangzhou. Now, with that recovery in demand, we think vacancy in general can stay under control. In particular, Chengdu vacancy should stay below 20%, but it will rise in Nanjing and later in Xi'an. We haven't shown the rents on this slide, but suffice it to say that the outlook for rents in the Tier 2 cities is generally more stable than in the Tier 1 cities. Next, please. Business Park. You see our forecasts for the Shanghai and Beijing business parks on the right of this slide. The Shanghai business park market has been firm, driven by demand from technology companies. For 2020, net absorption should be 0.8 times supply, while over 5 years, demand and supply should be perfectly balanced at 1 million square meters. While vacancy is high at nearly 23%, it should trend down over 5 years. Hence our forecast of flat rents this year in Shanghai Business Park, a much better outcome than in Shanghai office, and average annual rent growth of 1.2% over 5 years. Now, the Beijing business park market has been under greater pressure, but demand is now stabilizing. Supply this year and next year will be heavy. That's why we forecast a 6.8% drop in Beijing business park rents this year, but that sharp decline should moderate to a decline of 0.6% on average over the next 5 years. Next slide. Retail. As we noted at the start of this presentation, the Chinese retail market is rebounding. Fashion has been weak due to online competition, but food and beverages are picking up, while cinemas and exhibitions of renewable energy cars are attracting new traffic to malls. You see our forecast for the Shanghai and Beijing markets on the right of this slide. Both markets do face high retail supply between 2020 and 2022, especially in non-prime areas. That high supply should push up vacancy in both markets and explains the near-term pressure on rents that we predict, down 4 to 5% this year. Over 5 years, however, average annual new supply should only exceed demand by about 10%. And that's why we forecast only marginally negative average annual rent growth over 5 years. Next slide. What about cap rates? In the Tier 1 cities, CBD office cap rates lie in a range of 3.5 to 4.25%. DBD, decentralized business district, and business park cap rates are not much higher, lying in a range of 3.75 to 4.75%, while retail cap rates lie in a range of 4.5 to 5%. For the Tier 2 cities, in general, cap rates are 1 to 2 percentage points higher. Now, cap rates have expanded over 2020, given the perceived increasing level of risk. However, for 2021, we see cap rates staying flat or perhaps even declining slightly as prices are supported by liquidity in a recovering economy. All right, let's move on now to talk about the logistics market. Sorry, just about 1 second. As mentioned earlier, the Chinese economy is recovering strongly, and that is pushing up manufacturing. On the left-hand side of this chart, you see the China Manufacturing Purchasing Managers Index, which has recovered strongly over the second half of this year, indicating expansion in manufacturing. Why is that significant? It's important because about 40% of logistics volumes in China are driven by manufacturing. The chart on the right shows you growth of exports and growth of imports over the last several years. And between 2017 and 2019, both imports and exports grew strongly. For this year, as we saw earlier, apart from a very weak Q1, imports and export growth have been stronger than expected. So this bodes well for logistics. Next slide. While manufacturing drives about 40% of volumes in the Chinese logistics market, consumer-related e-commerce drives the remaining 60%. The chart on the top left shows that traditional e-commerce continues to expand. Just look at the regular strong year-on-year growth in sales for Alibaba on Double 11 or Singles Day. However, a new source of growth is the booming social e-commerce market, driven by brands like Pinduoduo or Xiaohongshu. An expansion in social e-commerce is putting pressure on the traditional e-commerce players. That's why some of the traditional players are looking at this market now, and that's why, for example, JD.com recently created a new and successful brand, Jingxi, in the social e-commerce market. Now, the social e-commerce players are increasingly targeting smaller cities and rural areas for growth. For example, more than 60% of JD.com's new users came from lower tier urban markets during this year's Double 11 event, and that includes new users through the Jingxi platform. Next slide. Now, this chart shows you an overview of the logistics market as of the end of the first half of 2020. We show figures for the past 3.5 years. Total stock has steadily expanded across the 33 cities, hotspot cities that Colliers tracks in China, and total logistics stock is now 60 million square meters. That number is up by 16% year on year. Occupancy has declined from a peak of 93% to 85%, but we still see that as a good figure considering the continuing growth in stock. Average rent across the hotspot cities has declined by 2% over the past year, but this chiefly reflects the fact that new logistics facilities are further away from city CBDs. Next slide, please. Now, in the previous slide, we saw aggregate rent. This slide shows you individual rents for the Tier 1 and the leading Tier 2 cities over the period 2018 to 2020. And there is a fairly consistent pattern of growth. Over those 3 years, we expect rents in Beijing to rise by 33% in total. In Shanghai, the figure is 17%, but the pattern is consistent. It's growth in nearly all the Tier 1 and surrounding Tier 2 cities. And with limited supply and high occupancy in these cities, rent growth should continue. Next slide, please. Now, new market trends are also continuing to drive volume growth in logistics. One important feature of logistics networks, if you look at the left-hand side of this slide, has been growth in so-called front distribution centers, FDCs, or mini front distribution centers, which are much closer to the customer. FDCs can ensure delivery to a customer in 1 day, mini FDCs in just 1 hour. And another trend has been the appearance of warehouses with multiple sides. Look at the right-hand side of this slide. E-shaped warehouses, U-shaped warehouses. These are significant because these new designs increase the number of loading docks from 10 to 20 to up to 50, permitting higher logistics volumes to be handled. Next slide. And another new trend driving efficiency is greater automation, and specifically the adoption of so-called intelligent management systems in warehouses. This boosts efficiency and it lowers labor and handling costs. More than 80% of logistics warehouses in China now have intelligent management systems, and they are typically upgraded every 6 to 12 months. This is a very fast-moving market. Next slide. An additional point to mention on logistics is growth in cold chain. One of the fastest expanding parts of the market, cold chain covers deliveries of fresh and frozen food, wines, medicines. Some new logistics facilities now combine refrigerated storage and express warehousing, and this means that they can handle both cold chain boxes and general goods. This is positive for efficiency and it's positive for rents, because cold chain rents are typically several times higher than standard dry warehouse rents. Next slide, please. Lastly, on logistics, we should just note that the investment scene remains very active. So far in 2020, 7 new investment platforms that have been raising capital have committed $11 billion to the Chinese logistics sector. And with demand firm, prices are well supported, and that is why cap rates continue to decline steadily. For 2021, we see cap rates for logistics assets in the Tier 1 cities of between 4.5 and 5.1%. Just lastly from me, let's talk quickly about another area of growth in the Chinese market, which is data centers. Next slide, please. Now, expansion in e-commerce is one factor, of course, driving growth in data centers, but the other is the increasing spread of 5G mobile networks, which is driving data volumes. An integrated mobile network, like the network you see in this chart, resembles a logistics network. The data centers at the edge of the mobile network correspond to the FDCs in logistics, while the cloud data center at the heart of the network corresponds to a large regional distribution center, RDC, in logistics. In a 5G mobile network, data can be transmitted between the edge data centers and the central cloud data center over wireless links rather than fixed cables, and many functions are processed at the edge of the network. These features boost speed and reduce latency and permit new applications such as self-driving vehicles and the Internet of Things. Next slide. As you can see here, institutional investors employ different routes to enter the Chinese data center market. One method is the private equity approach of investing in a data center operator, as Bain Capital recently did with Chin Data. Another method is to set up a joint venture with a data center operator, as Gore Capital has done with Centrin. Yet another method is to acquire assets from a data center platform, as Pin's investment did with Dr. Peng. So the investment scene overall remains very active, and you can see that the most aggressive player right now in Chinese logistics markets is the operator GDS. Next and last slide. Very finally, this slide shows total stock and total occupancy expressed in rack numbers, and the occupancy rate for the data center markets in the Tier 1 Chinese cities. For Beijing, Shanghai, and Shenzhen, demand is strong and occupancy rates stand at over 80%. Beijing has perhaps the highest demand of all, and supply is limited, so investors need to look at nearby cities such as Langfang and Huailai. However, Guangzhou faces some pressure on the occupancy rate from rising supply. That is it from me. Thank you very much. Let me please now hand you back to Betty.
Thank you, Andrew, for the insightful presentation. Okay, now we will move to our next session, panel discussion. Let's welcome Tammy Tang, MD of Colliers China. And she, co-founder and CEO of Forest Logistics.
Hello, hey, hi everyone. Thank you.
Thomas Liu, partners of Actis.
Hi there, good afternoon.
Simon Wang, General Manager of ESR East China.
Hello, everyone.
Over to you, Tammy.
All right, thank you, Betty. Thank you, Andrew, for a very comprehensive presentation. We have a very strong team of panel, very experienced from different backgrounds today. So let's go straight into some discussion. So guys, we have been hearing from Andrew some really positive numbers on logistics. Really on a lot of the picks up of the goods and the economic sectors and figures. I guess the most recent benchmark for us to look at is Double 11 figures, which we have recorded almost 500 billion of sales over 11 days on Tmall and over 271 billion sales on JD.com, plus a few others. In fact, the interesting part is the vertical platform, which we think are picking up the like of TikTok, only constitute to about 67% of the total sales volume recently. On the parcel, we have recorded 1.25 billion numbers of parcels being transported over this period of time. That is equal to the whole year number of 2010. So with all these numbers, and obviously we also have some discouraging numbers from the internet of what the press say about all these numbers are not real. In your own portfolio, do you really see a strong pickup in demand? I'll put this question to Simon because you have a huge portfolio. Simon?
Yeah, sorry.
So the question is, do you see a very strong pickup in demand, in particular during Double 11 time?
Yes, I think this year we received quite a number of space requirements from our current tenant. But because I think the festival not last for only 1 day, but it lasts for almost 2 weeks. So it gives a longer preparation period for all type of the e-commerce, I think. So make all the logistics flow in a rational manner. Even though the figure is high, but I think this year all our tenants respond to the customer quite quickly. I think make all the logistics flows more efficiently, I think. Yeah.
Right, and for Hank, your Simon's always more focused in East China for Simon's region, but for ESL. But for Hank, you have a pan-China portfolio. I believe some of them are already at leasing stage. Do you see strong demand as well in the last, let's say, quarter?
Yeah, definitely. First of all, thank you, Tammy, and say hi to two gentlemen. Thank you for having me. For those of the audience who don't know Forest Logistics, we are the developer, owner, and operator of modern warehouse space in China, and partnering with private equity, Daring Private Equity Asia, one of the largest PE funds in Asia. We start from 2008. We have accumulated more than 1.1 million square meters of higher warehouse space in China's Tier 1 and Tier 1.5 cities, including Shanghai and Beijing. And to answer Tammy's question, yes, the single days sales 115 billion US. That will equivalent to around more than 14 million square meters higher warehouse space in 1 day. So we already encountered very strong demand. For example, in our Chengdu project, we saw JD is looking for 200,000 square meter of space for the next year's pipeline. We also our cold storage space leads to JD cold storage company. So there's traditional e-commerce demand and associated 3PL demand, and as the Tammy and Simon just shared, the niche commerce company, the crowdsourcing company, Pinduoduo, Meicai, all these niche players. Right now, they have enough volume to rent part of even 20-30% of a traditional RDC. That's 10,000 to 30,000 square meter of space. Yeah, we are very confident by our actual leasing result.
Right. the two keywords I hear is cold storage. We will get to the second. And those two are criticizing Chengdu to say it's oversupply. Hang is seeing a lot of demand. How about you, Thomas? You also have a pan-China portfolio. Although you're one step back because you're investor, are you seeing good numbers in occupancy?
Well, thank you, Tammy, for having us, and thank you, Hank and Simon, for sharing this. Well, we're relatively newbies to this space. Also, we have started investing in logistics last year. So we have 5 projects. We've partnered with New East, but all 5 projects are in development phase. So unfortunately, we couldn't take advantage of any tenants' demand for this year's Double 11. But hopefully, we'll have some of these projects coming online for next year's. But having said that, some of the projects that are near completion, I think echoing earlier, I think Andrew's comments, we are seeing very strong pipelines of customers that are looking at leasing these space out, whether they're in tier 1 city or tier 1.5 city. So I think so far it shows that hopefully we make the right bets for sure, but the industry shows that the industry is very strong.
Right. So I think we hear from all experts, numbers are good, demand is strong. Let's go into something more specific. We did talk about cold chain as a big trend, and we do see a little bit of numbers and introduction from Andrew, and Hank specifically mentioned the like of Meituan. So are you guys seeing cold chain as a big driver for logistics in the future? And in particular, are we talking about purpose-built cold chain, or are you more leaning towards partial conversion? Question towards Simon. East China should be a big demand, right?
Yes, I think this year we received around 30% of inquiries is from cold chain logistic companies, and I think the social e-commerce also create a great demand for a mini fulfillment center for on the city level for those companies to create their own fulfillment center in first tier and second tier city. I think that will be a trend. And now we're inside of our company, I think we also discussed to transform some of our standard inventory warehouse into a cold storage warehouse. From the technology and the method, I think it's not very difficult. I think it will be definitely one of the key trends we're looking at into. Yeah.
So you opt for conversion instead of purpose built?
Yes, I think because the cost of BTS, if without end user, it's a bit risky, we think. But I think we can build the warehouse more flexible. So maybe we already installed the insulation layer under the ground. So when the customer want to transform into the warehouse into a cold storage, they only need to add a couple of walls and install all the to get a temperature controlled warehouse, I think.
Right. That's very smart, the way to do it. How about Hank? Would you opt for purpose build or build to suit, or would you just like allocate part of your warehouse for?
Yeah. First of all, thank you, Tammy. It's a great question. So we see this cold storage warehousing demand has been very strong, especially after the pandemic. People more on the public and private side, we all worry more about the supply chain safety and security. And we also see governments spend a lot of from government side, they offer a lot of tax cuts and lower industrial power rate to support this sector. And for us, we also see strong demand from growth in the healthcare sector. This today's news, UK just approved Pfizer's vaccine and for immunizations, right? So it's ready for distribution anytime soon. So all in all, help this sector, and we do both. And first of all, with 70%, we do partial conversion. Each of our RDC 100,000 to 200,000, we serve 15,000 to 20,000 space for conversion. As Simon just said, for floor insulation, ceiling insulation. Also, we can twist a little bit design to, it's the water supply and power supply is very crucial. We also, in terms of design, we play all this power station close to our cold chain storage space. All this detail, will help us save costs and save time for future conversion. And we actually team up with some end users, 3PL coaching 3PL companies and specialists for some BTS opportunities and for some the potential conversion. JD's storage actually lease our Chengdu warehouse is a successful case. We saw this a very strong story, the cold storage warehousing demand in China. Yes.
Right, so you will go for a full coaching, purpose-built BTS on coaching?
As long as long-term lease, it's a very capital intensive. It's very capital intensive. A lot of capex. Yeah. We are happy to work with experienced specialists and users, and they were, responsible for the OPEX. We invest in capex. We share a lot of infrastructure costs in advance. All the flooring and ceiling, as Simon knows, it costs money. Yeah, it's increased our GC costs around 3 to 5%, but better than we knock down our concrete and convert once we provide a generic warehouse. Don't plan for that. So with the long-term lease and our tenants willing to co-invest, we're happy to provide BTS. Yeah. Yes. Yeah.
Okay. Well, I guess if you do have a BTS project, you need capital, give us a call. So I think, from an investment perspective,
I was about to forward that question to Thomas. Will you go for a full coaching and portfolio?
Well, I think in terms of investment return, I think if you look at the rent yield that you can generate from a cold chain, if it's a build to suit, and if it's backed by, usually if it's big cold chain tenants, then it's a very high credit operator. Then it's a no-brainer to do that versus building spec and renting spec. I think the unfortunate, not unfortunate, but I think that the reality though, to do a build to suit is always a bit of chicken and egg. Right. So as an investor, before we commit for build to suit, most of the operator, they don't really commit to it until you start to have the work going. And so as an investor, they need to work with the partner like Hank, and when we look at those projects, when do we commit? When we sign up to it, we don't know exactly what's a spec, we don't know what to build and what the cost is. It's very hard for a fund like us or a PE fund to underwrite the projects. I think that is the challenge, right? So I think that's why I think most of the projects, it's still the kind of conversion project where you build it and with the flexibility to do both dry and cold storage tend to be still the most sensible way to go. But again, if there is someone willing to sign up a BTS upfront with a spec all predefined and a little bit like what we're doing with data center, if we do a build, that's a no-brainer to go in, and data center is even higher capital expenditure, but we'll still love to do it. And so yeah, cold chain would be ideal for, I think, not just for us but for most investors looking at this space.
Right, but you were looking at higher yields, yeah? Definitely.
It's higher yield.
While we're on this topic, not higher, right? While we're on this topic and a lot of interest, I have one last question for Simon. Well, we have a lot of new platform on verticals demanding coaching warehouse, right? Would you have a concern some of the new platform or new e-commerce company will not be there a year later? And how do you tackle that?
Well, that's a upgoing question for many years, I think. Yeah. But I think we're trying to build
because on coaching, probably adjust.
Yeah. I think the thing is, because the new regulation on constructions, which only allowed you to build a certain number of space within one warehouses. So if you have a DC within very close to downtown, that's definitely a good location. So if one customer moving in and moving out, definitely you can find another one. But if you build a warehouse like further away from the city center, then you have to be careful with that. Yeah. So I think our strategy is to try to leave more flexibility to the warehouse itself, and allows more customer to because recently we just signed a contract with a medicine company, and it requires -70 degree to store medicines. So sometimes it's very difficult to measure how they want to storage their product, and they have a different temperature control range. So if we build a standard cold chain warehouses, it's quite difficult to meet their requirements. Yeah.
So,
Right.
So Tammy,
So
just want to.
So we have to probably do more to learn. Yeah.
Yeah, it's just I want to add to Simon's point, because offline we talk about some developer, with a developer willing to go to tier 3 or tier 4 cities, because actually there's some tenant concentration risk there. It's just kind of echo your question. If one of a new platform, they die 1 year, 2 years later. That's why for most of foreign-based capital, we tend to build in tier 1 and tier 1.5 cities, where most dense population, most strong retail sales, and we have a very healthy tenant dynamic, tenant balance. Yeah, 2, 3 anchor tenants and a bit small one to support RDC. Yeah, that's been more healthy.
To go into that, I was about to go to that next topic, which is always discussed and talked about, which is our next location, right? We talk a lot about e-commerce sales happening in the rural and village area. Normally, we call them like the sinking market or rural markets in tier 3 and 4 city. What's your view on that? It looks like many of our developers have a huge hesitation on that. So back to Simon again. What's your view on certain 4P city? Will you even go for that, and why?
Well, I think we in the past 3 or 4 years, there's many developers go to the second and third tier city, which create a great amount of inventories for the city. So for a period of time, I think we try to digest that kind of higher stock space. But as the market, I think now we will start to see that the vacancy rate has dropped. I think because the social commerce and also the group buying and like Pinduoduo, I think we see more platform sinking their FDCs into the second and third tier city. Also because there are a lot of cold storage requirements, so you can't send out your product like 100 miles away. So you have to set up your city distribution center near the second and third tier cities. So I believe there will be a more mini storage warehouses in those cities, and to service those kind of customers. Yeah, and also I think because of COVID-19 this year, because the lockdown period encouraged a lot of more people to buying products online rather than offline. So people like my mom, they start to buying smartphones and download those apps and buying stuff online, and create a great amount of needs for logistics. Also, my wife's buying a lot of stuff online. Also, they return a lot of stuff. I think this also creates a great amount of stock and shipment for logistics, I think. Yeah. So it's definitely one of the market we're looking into, and still keen on the second and third tier city to create a network to service our customer. Yes.
Right. Very interesting. Simon mentioned the smaller warehouse, maybe mid warehouse in maybe a lower grade market. Thomas, as an investor, will you go for a grade B portfolio or like a mini warehouse portfolio, and why?
Yeah, I think from an investor, again, there are different categories of investors, right? So for us, we are a opportunistic value add fund, and so the return that we're seeking are some would cost greedy, but we're looking at 18% plus IRR in that kind of range. So you need to achieve that kind of return. I think the math is actually quite simple. You need to build very quickly and then stabilize it and then exit at a. So, but then what that means is, with tier 1 city, I think Andrew's chart just now shows that tier 1 city stocks are now exiting, stabilized trading at 5 cap. So at 5 cap, if we want to generate the kind of return, that means we have to stabilize and build on the yield on cost basis somewhere in the high 6 to 7% cap rates. And so to achieve that, when land cost is probably the smaller components of a total cost, is really in the construction cost. And construction cost is pretty stable across whether you're in tier 1 or tier 3 cities. And so as a result, with cities that have a lower rent, it's just more difficult, right, for the assets to achieve that kind of a stabilized yield. And so I think since we are a more financial investor, we have to cherry pick, projects closer to tier 1, tier 1.5. And selected tier 2 cities that have a better supply demand dynamic. But when it gets to tier 3, I think for now we're gonna shy away from there. But certainly for operator that has a huge national portfolio and with a national base of customer that wants to penetrate all the markets. I mean, certainly something like ESR, and that makes a lot of sense to have to canvas the whole market and cover all the bases. But since we're the greedy investor, we have to stay away for now.
That's fine. I mean, I'm not forcing you. I just want to hear your view. Hank, what do you offer?
Yeah.
Will you offer limited opportunity?
I share more with Thomas' view because it's about opportunity cost of our capital. So we so far we still stick to tier 1, tier 1.5 cities because as Thomas perfectly explained, to achieve the same mid-teen type of EIR return in tier 3 cities where the rent only probably half of what tier 1 city can provide, our land price need to come down to 100,000 something, 150,000 per move, and that's would be very difficult. That would be very difficult, especially because the construction costs are pretty transparent, pretty stable. So it's about a return issue, and that's why with our capital we tend to stick to tier 1, tier 1.5 cities with most dense population and a more healthier tenant dynamics, tenant mix. Yes.
Right, and then as a follow-up question, given we all know how hard it is to get land in tier 1 and tier 1.5, how do you expand? Hank, you can continue before I go to the next, the other guesses.
Yeah, okay, sure. So we have, over the last 18 months after we established Forest Logistic Properties, we successfully accumulate 10 sites over 18 months, including Shanghai, Beijing, and some of the traditional siting, logistics site in Wuhan, Chengdu, Xi'an, Changsha, Kunming, all these great logistics hubs. And we have strategic alliance with a lot of good industrial companies. They are good taxpayers. They contribute a lot of employment to the local economy. For example, we work with the integrated vehicle platform in China, and we built two together. We acquired 2 great logistics sites with them, and we also team up with one of the largest food processing company in Europe, who pay a lot of tax revenue to some province we're targeting on. We team up with them for land acquisition. Also, some cross-border e-trade companies. We also team up with these great industrial companies. That's our track record shows this works. And government like these great tax contributors in tier 1, tier 1.5 cities, and we're growing very fast and healthy. Yes.
I'm hearing a lot of good tactics here and strategy here. Simon, same question to you. Then East China is the most competitive city to get supply. What's your tactics?
I think we are using similar strategy as Tang mentioned. We're trying to find the more find a partner that can contribute a lot of the tax. So we tend to persuade our customers. Sometimes even have to educate the customer. They have to pay tax locally in order to get the space. So I think there's a trend in this region. More and more giant 3PL companies try to consolidate their warehouses together and to register a company locally rather than they don't have to register a company before. And the second strategy is we're trying to buy e-commerce companies with the 3PL company together into a park. So some of the company can register and pay tax, but some don't. Normally, I think the government also allows you to do that. Yes, I think the strategy ESR has also is we focus on the first tier city. And for the second and third city, we don't encounter the problem to get land. Yeah, because we serve a customer through our network. So I think for some companies, they register in the first tier city, but for the second and third, they don't register in there. Yeah.
Right. And Thomas, because this is really not your problem, because you're investing into whoever already got land. But to twist it a little bit, will you go straight to an occupier and invest with them? You know, given maybe I'm like a current user or I'm an e-commerce company, or will you go for a professional developer?
I think we still want to back professional developer. I think because in that case, the interest is more aligned because the developers, the goal is to buy land, develop, and then make a profit, which is very aligned with the financial investor. I think the issue with the end user is that they have a very different time horizon in terms of their view of how long they want to use the facility, whereas we have want a quick turnaround in the capital asset turnover. So I think that's the misalignment there. Having said that, I think what Hang described at his tactic of finding land is very similar to some of the partner that we're talking to. Right, they would have either financial backer or partner within that group that are industrialists that are already contributing tax revenue to the local government, and so it's easier for them to negotiate and access logistic land. I think that this is a game. Everyone's trying the same tactic to try to get access to land, and I think I'm as you said, I'm luckier than Hank and Simon. I'm the financial backer, right? So I can talk to different people, and if you have land, come knock on my door. But having said that, I think it's Andrew's. In the slide, there's $11 billion raise for. So I'm just a very small part of the 11 billion. So my knocks don't get knocked on very often by people because there's too many doors out there now waiting to be knocked by people like Hank and Simon. And so we just hope to play it in a little small pond in this game.
Right, and that comment actually is very valuable because a lot of investors is thinking about, oh, shall we go straight to an occupier? But then there, your comments on the change of business strategy, are they professional in development? I think all these are big concerns. With a lot of money going into the market in logistics and all the good numbers supporting, we're seeing cap rates. Let's look at numbers now. Cap rates are on a compression mode or trend for the last 10, 15 years. In particular in first tier city, yeah? So will you still opt for first tier city and 1.5 city given it's already very expensive? I'll throw that at Hank. It looks like you want to answer.
Yeah, we definitely see the yield compression story for China logistics sector because especially from March, China is launching the pilot equity REITs program. We expect to see more domestic capital into the sector, provide more liquidity, and people, there will be more core type of vehicle, type of investor into this sector. So it's overall very healthy. Will further bring down the yield, and we foresee the gap, the spread between office yield and logistic yield will be narrower and narrower in tier 1.5 cities because some of the portfolio in terms of scale, once reaching certain scale, we saw the transaction already sub-5 for some the logistic transactions, portfolio transaction already sub-5, less than 5%. So we foresee in the coming in the next 2-3 years maybe come down to 4.5. I will be not surprised. I'm not surprised. In Singapore, some of the logistic yield already lower than office yield. So we see in China, tier 1 cities will follow this trend gradually. Yes.
How about you, Simon? Really 5% to 4.5 in Shanghai or even lower? What's your view on the cap rate trend?
Well, that's I think in Shanghai, because the scarcity of land supply and the limitation that the government don't have so many quota for logistic developers. So I think the cap rate will definitely drop in the coming years. I think I have the same opinion with Hank. I believe in the coming 5 years, maybe the cap rate will be similar to the office. I think, yeah.
So downtown office, we're talking what Betty will know better. What 3.5%, 4%? Yeah. How much your view? No more office or warehouse? 4% for Shanghai?
Well, I think, well, again, just don't want to quote Andrew again, but if you look at his slides, right, there are a lot more supply-demand imbalance in office in the tier 1 city in China than the logistics. And there's there's shortage of supply of land, and then there's this continued demand growth. Whereas setting in office, there are a lot of supply growth, at least in the next 5 years. So I think that tells the story of which way the yield's going to go. And just overall, I think yield. I think China just for the first time issued a sovereign bond at negative yield and got oversubscribed. And so even if, and then you talk about all the Japan and all the European bonds, even people are paying people to borrow their money. So in this environment and given COVID and after all the expansion of fiscal policies everywhere in the world that we're going to see in over the next couple of years to take the economies out, yield's not going anywhere up in increased direction. It's going to keep at this level, if not compressed. And so as a result, there will be more investors continue to look for yield in hard assets. And so this means not just logistics, and that's why we're seeing this great interest, in data center, frankly, in other kind of infrastructure hard assets. It has attracted a lot more capital over the last couple of years, and we do see this trend continue. And as a result, yield will inevitably for a high quality assets like logistics will continue to compress. So now there's no crystal ball when it will get to 4.5 or when it will get to 4, but we're heading in that direction.
How about second tier city, Thomas, if you continue? What's your view on the provincial second tier cities, the like of like Chengdu, Xi'an, Shenyang or Changsha? Is it around 6 or is there a view to look at 5?
At least you're at 6. I think many of them are already below 6. But I think the overall yield trend is going to, I think they all kind of run in parallels, right? As tier 1 goes down, tier 2 will kind of follow in trends. I think it depends a bit on, in the tier 2 city, you tend to have city that have a bit more supply demand challenge. I think Tang seems to have great experience in Chengdu, but I think there are other operators that have different stories about Chengdu. But so I think overall, when investors look at those locations, they will have a different view on the yield based on their expectation of the stabilization of yield. But overall, I think the overall yield trend is still trending down. Now, whether it's a 6 to a 5 to 5 3/4 or a 5 3/4 to 5.6, it's heading in that direction again. But it's but if you go down more micro level to each city, that might vary based on supply demand.
Right. So, Hank, would you think it is like a 1 percentage point spread from tier 1 or tier 2, or is it more like city to city?
I think it's all come down to micro locations. For example, our project in Wuhan is in Dongxihu. It's a great traditional logistics hub, good for 3PL, good for e-commerce, good for cold storage as well. So, GOP, ESR, they have lots of good warehousing facilities over there, can be traded lower than other in Chengdu, than in Kunming. So we don't do individual trade sell, and we prefer the portfolio exit. So we believe that for portfolio exit, we can offer some premium to in terms of the cap rate. And actually, for most of the portfolio sell, with tier 1 and tier 1.5 city mix portfolio, sub 5 is achievable. That's being achieved. Yes, something has achieved. So we actually don't look at what's Chengdu. Yes, for annual valuation, we look at that, but we've reached a certain scale. Right now, our portfolio, we have around 1.5 billion US AUM, and once we double that, we believe that sub 5x cap rate portfolio sale can be achieved. Yes.
Okay. And Simon, what about you? From Shanghai to, let's say, your Hefei or Shaoxing, Zhejiang, Jiangsu, Nantong, Nanjing, what's the spread like?
I think yes. I think the cap we're talking about is also a market will teach us itself. So sometimes if you enter a second, even third tier city, And we're looking into how many stock it currently have and what's the vacancy rate. I think normally we ourselves a portfolio. We'll always combine the first tier city with some second, third tier cities product together. So sometimes I think I totally agree with Thomas. I think we're heading there. The technical will compress in a way, but it's just when the time is coming. I think we're in a trend today.
All right. Well, thanks, guys. I think time is up. Unfortunately, we don't have time for questions with our audiences, but let me have 30 seconds to go around the room and say your hot pick city. Tang, hot pick.
We're a project definitely near Yangtze River Delta regions. We have Shanghai, we have Nanjing, we have Hangzhou, Suzhou, and near Beijing, we have one project. Near Beijing, near Shanghai, near South Great Bay Area. This is our target, economic cluster.
Simon, what's your hottest?
Same with Tang. All the satellite city around Beijing, Shanghai, Guangzhou, and Shenzhen. That's definitely our spot city.
Right, Thomas.
Well, if I have to pick one, I'm not like the other two panel. I have to pick one. It will be Beijing, and that area. I think the supply is much more constrained compared to all the other tier 1 cities. So that dynamic is very good. So if I have to pick one, I'll do Beijing all day long. But I wish usually this kind of wish usually don't come true. But
Beijing and Shenzhen.
Okay,
yeah.
Okay, thanks, guys. Our time is up. I'll tell all our brokers what to do. Right, Shanghai, Beijing, Guangzhou, Shenzhen. Got it. Okay, thank you very much. Back to Betty.
Thank you.
Thank you.
Thank you, and that concludes the session for today. Thank you for our esteemed panel of presenters and speakers and great friends. And thank you to you too, our audience, for taking the time out to join us today. And do join us again next week on Thursday, 10th of December at the same time as my colleague Ota-san will be hosting you for an in-depth look into Japan, along with Andrew and other guest panelists. And we look forward to share more with you then, and thank you and have a nice day.
Thank you, Betty. Thank you.
Thank you, Betty. Thank you, Tammy.
Goodbye.
Thank you.
Thank you, Tammy. Thank you, Andrew. Thank you, gentlemen.
Bye, everybody. Bye-bye.
Thank you.